As low conviction investors, I think it's hard for us to ever get too excited about anything. But I think broadly speaking, if we look at where value sits relative to the rest of the world, value stocks have bounced off of the all-time lows in COVID, but something like IFA value versus IFA still is at the bottom end of the 30-year range. Trades on a next 12 months PE basis in the high single digits versus a long-term median more in the low double digits, low teens. So it seems like value stocks might still have some room to run in terms of outperformance looking ahead. If we think by region, the Russia invasion of Ukraine created a lot of disruption last year, and that's now led to knock-on cyclical opportunities for us in Europe. In Japan, the Tokyo Stock Exchange announcement encouraging companies to get to 1x book has helped reignite international investor interest in Japan, and we're starting to see early signs of improved shareholder awareness on the behalf of Japanese corporates. And finally, emerging markets remains a meaningful part of the portfolio at about a 15% overweight. EM broadly has had a decade of underperformance, and it really has led to very weak sentiment and a lot of stocks falling into our range of low price, low valuations, and low expectations. So we're always bottom-up investors, and where you see exposures in the portfolio, that's really an aggregation of where we're finding names that check our boxes of low price, low valuations, low expectations. EM is a diverse category, and so it's a simple label for a very complex set of assets. In ICV, we own stocks across more than 15 different countries. Our largest overweights are in Brazil and Korea. And the nice part about emerging markets is often they experience unusual levels of volatility, which can give us a shot at really great companies. So maybe there's an election, investors get scared, and the baby gets thrown out with the bathwater, and we're able to buy high quality franchises with leading market share at 15-year lows on price, valuations, and expectations. So what we're trying to do in ICV is find companies that have fallen to 10 to 20-year lows. And we call it low, low, low. And we have typically 5 boxes that we're looking for any stock to check. And when we get together as a team and review names, that's really what we're doing, is we're trying to figure out how many of the boxes does it check, and if it does, it goes in the portfolio. So the first box is low relative price. We're looking for stocks that have underperformed relative to our index. The second is low valuations. We're looking for valuations that are 10 to 20-year lows, typically something like EV to sales against a normalized operating margin. And third, we're looking for low expectations. We want sentiment to be an overhang. Maybe the sell side is too negative on the profitability outlook looking out a couple years. The fourth box is strong balance sheets. Companies may be going through a cyclical downturn, and we need to have time on our side. So a strong balance sheet gives us time to wait for things to get better, and hopefully it also allows us to make more patient and rational decisions. And fifth is a lot of upside potential. So we're really looking for companies where we think we're getting compensated for the risk that we're taking when we're buying at that 10 to 20-year low. So we're always evaluating, whatever's taking new lows. But we also do it within a risk-aware framework. And so part of what we're considering is are there other risks outside of just the fundamentals that should factor in? And if we look at Chinese stocks over time, they had a long stretch of outperformance and strong growth. Now they've entered a more challenging period, so there are more names that are starting to tick our boxes, but what we're trying to do is assess what does normal look like? And given some changing economic regimes and policies, it may be a little bit harder for us to get that sense of normal. So we always think about things in a hurdle rate. And so if we have maybe higher geopolitical risk or less of a sense of what normal is, that hurdle rate might tick up for an incremental new name in China. So it's always something we're open to, but we're trying to also manage risk at the same time.